Imagine your credit card has a balance of a few $1,000s and it's locked in at a comfortable 2% interest rate. It's manageable. You make your payments and life goes on. Now, imagine you get a letter in the mail. That whole balance has been moved to a new card, and your new interest rate is 5%. Suddenly, your minimum payment doubles, maybe even triples. That once manageable debt is now a source of serious financial stress. You'd have to cut back on groceries, delay a car repair, maybe rethink your vacation plans entirely. For you, that might be a few $1,000s. For the United States government, we're talking about trillions. With a staggering gross national debt that has now surpassed $38 trillion, dollars, the country is facing an unprecedented financial challenge. For years, a mountain of debt was made manageable by historically low interest rates, but that era is definitively over. And just like with that credit card, the US is now being forced to refinance trillions of dollars of its old, cheap debt at today's much, much higher costs. This isn't some abstract economic theory. It's a fundamental shift that is happening right now, and it's creating a fiscal time bomb with a fuse that's getting shorter every single day. So, what's really going on? How is this quietly changing the American economy? And what does it mean for you, your money, and your future? For more than a decade, the US government operated in a kind of financial paradise. The average interest rate it paid on its debt was consistently low. 5 years ago, that rate was a mere 1.583%. This low rate world made the consequences of massive borrowing feel distant and theoretical. The debt could climb, but as long as servicing it was cheap, Washington kept spending. It created a dangerous sense of complacency. That illusion has been shattered. To fight the soaring inflation that started in 2022, the Federal Reserve had to aggressively raise its benchmark interest rate. This had a direct and immediate impact on the cost of government borrowing. Rates on new Treasury securities shot up. While it was a necessary move to tame inflation, it triggered a ticking time bomb in the federal budget. This brings us to what experts call the refinancing wall. Imagine a massive wall of debt maturing each year. In the past, rolling it over was like climbing a gentle slope. Today, it's like scaling a sheer cliff. Let's put some numbers on it. A 10-year Treasury note issued 5 years ago might have had an interest rate of around 1.5%. $1 trillion chunk of that debt would cost about $15 billion dollars a year in interest. But today, a new 10-year note is issued at a rate closer to 4%. So when that old debt matures, refinancing it means the annual interest cost explodes from $15 billion dollars to $40 billion. Dollars. That's an extra $25 billion dollars a year for the same amount of underlying debt. Now, multiply that effect across trillions of dollars. All of it has to be rolled over from the low rate environment it was born in into the high rate world we live in now. This isn't a one time shock. It's a relentless, grinding process that will steadily drive up the government's interest burden for years, even if Washington doesn't add a single new dollar of spending. The consequences lead to a scenario that economists call a fiscal doom loop, a self perpetuating cycle that's incredibly hard to break. Here's how it works: rising interest rates. Market forces or the Fed push rates up. Higher interest payments. The cost to service the debt automatically goes up as old, cheap bonds are refinanced at new, higher rates. Bigger deficits. These higher interest payments are a form of spending, blowing a bigger hole in the budget and increasing the annual deficit. More borrowing. To cover the larger deficit, the government has to borrow even more money. Pressure on rates. This constant, massive new supply of treasury bonds can overwhelm investor demand, forcing the government to offer even higher interest rates to attract buyers, which feeds right back into step one. We are already seeing this doom loop in action. For the first time in history, the US government's annual net interest payments on the debt surpassed $1 trillion dollars in fiscal year 2025. To put that in perspective, just 5 years ago, the total interest cost was $345 billion. dollars. It has nearly tripled. This isn't just a number in a report. $1 trillion dollars is a monumental sum. It means the United States now spends more on interest payments than on its entire national defense budget. It's more than it spends on Medicare. It's more than it spends on veterans' benefits, transportation, and nutrition services combined. The Nonpartisan Congressional Budget Office, CBO, projects that interest will be the fastest growing part of the federal budget. By 2035, annual interest payments are projected to hit $1.8 trillion. dollars. Under some scenarios, that figure could soar to $2.2 trillion dollars per year. This is money that provides no services. It doesn't build a road, fund a discovery, or pay a soldier's salary. It is simply the cost of past decisions, and it's growing at a pace that threatens to suffocate every other national priority. So, how did we get here? First, let's try to wrap our heads around the sheer scale of the number $38 trillion. dollars. As of late 2025, the US gross national debt stands at $38.4 trillion. dollars. It's a number so large it almost loses its meaning. If you spent $1 million dollars every single day, it would take you over 100,000 years to burn through $38 trillion. dollars. The debt has been growing at an average rate of $6.12 billion dollars per day over the past year. That's over $70,000 every single second. Divided among every household in the country, that's a burden of about $285,000 each. Now, people often confuse the debt and the deficit. Think of it this way: the deficit is the shortfall in a single year, when the government spends more than it brings in through taxes. To cover that gap, the Treasury Department borrows money by selling securities, like Treasury bonds. The national debt is the grand total of all those annual deficits, year after year. It's everything the US has ever borrowed and hasn't yet paid back. This debt is broken into two main piles. The first is intragovernmental debt, which is money the government owes itself. For instance, the Social Security Administration might have a surplus, which it lends to the rest of the government. This accounts for about $7.56 trillion dollars of the total. The second, much larger pile is debt held by the public. This is what the government owes to everyone else: individuals, companies, banks, and even foreign governments who buy US Treasury securities. As of late 2025, debt held by the public is over $30,800 billion. That's not just a big number, it's more than 115% of America's entire gross domestic product, or GDP. This means the country owes more than its entire economy produces in a year. The last time the ratio was even in this ballpark was right after World War II, a time of extreme national sacrifice. For over a decade, this growing mountain didn't feel like a crisis. Why? After the 2008 financial crash, the Federal Reserve pushed interest rates to near zero. This created an era of incredibly cheap money. The government could borrow trillions for tax cuts, stimulus packages, and social programs without the immediate sting of high interest costs. It was like taking out a massive mortgage with a super low introductory rate. But the government doesn't just borrow once and pay it back 30 years later. The debt is a constantly churning machine. Treasury securities are issued for different lengths of time: short term bills, medium term notes, and long term bonds. As these older IOUs mature, the Treasury has to pay them back. And to get the cash to do that, it issues new debt. This is called rolling over the debt. And here's the core of the problem: a huge amount of that cheap debt is now coming due. Roughly one third of all publicly held US debt is set to mature within the next year. That's trillions of dollars that were borrowed when interest rates were around 1.6% that now have to be refinanced at today's rates, which are more than double that. The average interest rate on marketable US debt now stands at 3.382%. The introductory offer has expired, and the standard, much higher, APR just kicked in. Navigating this complex economic landscape can feel overwhelming, especially when thinking about how to protect your own financial future. That's why it's more important than ever to have a clear and organized view of your finances. Our sponsor for today's video, Lay, helps you do exactly that. Their platform allows you to track all your investments, monitor your net worth, and plan for your long term goals in one secure place, in an environment of rising interest rates and economic uncertainty. Knowing where you stand is the first step toward making smart decisions, gives you the tools to analyze your portfolio, identify risks, and stay on top of your financial health. If you're ready to take control of your financial future and build a resilient portfolio, check out the link in the description below to get started with. Using our link helps support the channel and allows us to keep making deep dives like this one. Now, back to the debt crisis. So, $1 trillion in interest sounds bad for the government, but what does it mean for you? How does this massive number in Washington affect your daily life, your job, and your savings? The answer is in more ways than you might think. The most direct impact is something called crowding out. The government is such a massive borrower that it acts like a giant vacuum cleaner, sucking up a huge portion of the available savings in the economy. This is money that could have otherwise been used by the private sector. When you put money in a savings account or a pension fund invests for its retirees, that money can become a mortgage for a new home, a loan for a small business, or capital for a startup. But when the government is selling trillions in attractive, risk free bonds, it competes for that same pool of money. This does a couple of key things. First, it drives up borrowing costs for everyone. To compete with the government, banks have to offer higher interest rates. That means higher rates on mortgages, car loans, and credit cards. The Government Accountability Office has warned that rising debt directly contributes to higher borrowing costs for families and businesses. So when you see mortgage rates creeping up, making it harder to afford a home, the government's insatiable need for cash is a big reason why. Second, it can stifle the economy. When businesses have to pay more to borrow, they have less to invest in new factories, better equipment, or R&D. This leads to lower productivity growth, which is the ultimate engine of rising wages. Less investment means fewer new jobs and stagnant paychecks. The CBO estimates that high and rising debt will slow economic growth over the long term, with one analysis suggesting it could reduce income growth by as much as two-thirds between now and 2055. Another major risk is future inflation. If the debt burden becomes so large that the government can't realistically pay it back through taxes or spending cuts, it may be tempted to turn to the one entity that can create money out of thin air: the central bank. This is called monetizing the debt. The Fed would essentially print money to buy the government's bonds. This might seem like an easy out, but it's a classic recipe for hyperinflation. When the money supply explodes without a corresponding increase in economic output, the value of each dollar plummets. Your savings get wiped out, and the cost of living skyrockets. It's a hidden tax that hurts everyone, especially those on fixed incomes. Finally, there's the direct burden on you as a taxpayer. That projected $1.8 trillion in annual interest has to be paid for. The money can only come from two places: cutting government services or raising your taxes. Every dollar spent on interest is a dollar that can't be used to fix roads, fund schools, or provide for national security. As interest costs eat up more of the budget pie, it squeezes out everything else. This leads to a painful conversation about what gets cut: Social Security, Medicare, infrastructure. If those cuts are politically impossible, the only other option is higher taxes. And we're not talking about small tweaks. The tax hikes would have to be significant and broad based, hitting most households and businesses. The current path is unsustainable. Sooner or later, the bill will come due, paid for with lower benefits, higher taxes, or devalued savings. If the problem is so severe, why isn't Washington doing anything? The simple answer is that all the solutions are politically toxic. There are no easy choices. And in a deeply divided country, making hard choices has become nearly impossible. There are really only three levers to pull: cut spending, raise taxes, or try to grow our way out of it. First, spending cuts. When you look at the federal budget, most spending is on autopilot. It's for mandatory programs like Social Security, Medicare, and Medicaid, plus interest on the debt itself. These programs, plus interest, account for the vast majority of all federal spending. Reforming these popular entitlements could mean raising the retirement age or reducing benefits, moves that are politically radioactive. What about the rest of the budget? Discretionary spending. This is what Congress debates each year: funding for defense, education, infrastructure, and the FBI. Even if you made drastic cuts here, it wouldn't be enough to fix the long term problem. The math simply doesn't work without touching the big mandatory programs. The second lever is raising taxes. Just like spending cuts, this is deeply unpopular. To make a real dent, taxes would have to go up for most Americans, not just the wealthy. This could slow the economy, and politically, no one wants to be the one telling voters they have to hand over more of their money, especially when it's just to pay interest. The third option is to hope the economy grows so fast that it shrinks the debt relative to GDP. This is the most politically attractive path because it requires no direct sacrifice. The problem is, it's not a realistic solution on its own. The CBO projects debt held by the public will surge to 156% of GDP by 2055. Reversing that through growth alone would require an economic boom far beyond what any mainstream economist thinks is possible. In fact, the high debt itself acts as a drag on growth, making this option even less likely. This political paralysis is why the US keeps hurtling toward a fiscal crisis. Both parties have chosen massive unpaid for spending and tax cuts over fiscal responsibility. This inaction has prompted stark warnings from top figures in finance and economics, who say the US is on an unsustainable path that poses significant risks to our future. We started with a simple credit card analogy. For the US government, this isn't an analogy. It's a multi-trillion-dollar reality. The era of cheap money that masked the true cost of our national debt is over. We are now face to face with the brutal math of refinancing a $38 trillion debt in a world of higher interest rates. The consequences are no longer theoretical, they are here. We see it in interest payments that have crossed the $1 trillion mark, consuming more of our budget than defense or Medicare. We see it in projections of a debt that will soar to levels that could choke off economic growth for decades. And we feel it in higher borrowing costs and the threat of future tax hikes or deep cuts to services we rely on. The path we are on is not sustainable. The doom loop of rising debt, higher interest payments, and bigger deficits is spinning faster. Yet our political system seems incapable of making the difficult choices required to change course. This leaves us in a perilous position. A slow moving fiscal crisis is silently eroding our economic foundation and placing an ever heavier burden on future generations. Ignoring this problem won't make it go away. It will only make the eventual reckoning more severe. The real question is no longer if we'll be forced to deal with this, but when and how. Will it be through a proactive, bipartisan plan that involves shared sacrifice? Or will we wait for a full blown financial crisis to force our hand? What sacrifices do you think will be necessary? And do you believe our leaders are capable of making them? Let us know your thoughts in the comments below. If you found this video informative, please hit the like button and subscribe for more deep dives into the economic issues that shape our world. Thank you for watching,